Hello, my name is Rick Weinzierl, and the topic that I will introduce in this webinar is taxation for small farms. This is part of a broader discussion of business planning and legal issues planning that is presented in several of our classes and webinars as part of our Beginning Farmer course, Preparing a New Generation of Illinois Fruit and Vegetable Farmers. This course is funded by the United States Department of Agriculture's National Institute for Food and Agriculture, and specifically NEFA's Beginning Farmer and Rancher Development Program. Webinars and references on the topics that we cover in our classes are available online at www.newillinoisfarmers.org. In other webinars and discussions, we address the importance of business structures, farm, liability, and crop insurance, and labor management and labor relations. This discussion focuses on planning for tax liabilities and deductions, specifically sales tax, income tax, self-employment tax, and withholding taxes for employees. You will begin to use, if you do not already, IRS Schedule F for reporting farm income and deductions for your federal tax return. We'll also talk briefly about excise and property taxes. Remember that the discussion of taxes is important because tax liabilities have to be factored into your business plans. Tax liabilities are not really very different from the costs of land, equipment, fuel, seeds, and other expenses necessary for running your farm. They become part of the difference between your gross sales and net after-tax income. During the course of this discussion, I'll include links to several useful references or resources. 3 that provide valuable information on a range of small farm business management issues are the Illinois Direct Farm Business Guide, an online publication, Farm Commons, a nonprofit agency that has archived webinars on a range of business management topics available online, and the Small Business Development Centers that provide one-on-one consulting services. An important disclaimer before I delve into this topic. I am not a tax specialist or a tax attorney. What I'll do over the next several minutes is introduce you to several important topics that I've been taught in Train the Trainer sessions and that I'm preparing to deal with as I start a small farming operation. You will become aware of some tax issues that you may not have thought of if you have not run an independent business before. With that awareness, you'll need to follow up with your own research into details that affect you. And you'll have to decide what management practices you can do on your own and what practices you may want to pay someone else to do. Remember not to be too frugal to pay for the services of a qualified attorney or a good tax accountant who is familiar with farm taxation. Employment law is long and complex, and there are tons of regulations and rules. Related to taxation, at least 3 topics deserve your attention: whether or not someone is an employee, your obligation to pay unemployment insurance, and your obligation to withhold income taxes from employees' checks. One issue surrounded by muddy water is the practice of having volunteers come regularly to a small farm and help with the harvest, and to be rewarded or thanked with a significant amount of produce or other farm products. Volunteers, who are compensated with free produce, may not be viewed as volunteers under the Fair Labor Standards Act. If they are compensated, the fair market value of the produce they receive is the basis for withholding taxes. And this is often ignored, but remember to do so at your own risk. Another issue is whether or not someone who comes to your farm to work is an employee or an independent contractor. We'll save the topic of interns versus employees for another date because wages, not taxation, are usually the focus of that distinction. If someone is truly an independent contractor who comes to your farm to provide you a professional service, you are not obligated to withhold payroll taxes from the money you pay him or her. It might be tempting to want to avoid the payroll tax paperwork and call everyone an independent contractor and let them report their income and pay their taxes on their own. But Angela Tucker of Land of Lincoln Legal Services offered this explanation on the perils of describing an employee as a contractor. Whether a worker is an employee or an independent contractor is an individualized fact question. That means that a jury may decide, which also means there are no standard simple rules. Instead, it's what lawyers call a totality of circumstances test. This is a fancy way of saying that you look at the whole situation. Courts have generally looked at the 6 factors in this slide. While none of these factors is by itself determinative, courts generally don't care what you want to call the relationship, whether you call it an employee or an independent contractor. Courts will almost always find an employer-employee relationship where the employer exercises control over the manner in which the work is performed. Just because a working relationship is seasonal does not mean that workers will be considered independent contractors. Generally, if you want someone to be classified as an independent contractor, they have to have some skin in the game of the work they do. That is, they have to share in the proper profit or loss of a business. How about unemployment compensation or insurance? Most for-profit employers are required to pay contributions or taxes as soon as they have paid $1,500 in wages in a single calendar quarter, or employed 1 or more persons for 20 weeks in a given calendar year, or if they have paid $1,000 in cash wages in 1 calendar quarter for domestic work, or if they've paid $20,000 in cash wages in 1 calendar year, or employed 10 or more workers for 20 weeks in a given calendar year for farm work. However, unemployment compensation rules differ a bit in agriculture. Under federal law, agricultural employment is subject to the Unemployment Compensation Act if the farm employer pays cash wages of $20,000 or more to employees during any calendar quarter of the current or preceding calendar year, or the farmer employs 10 or more individual employees on at least 1 day during each of 20 different calendar weeks. However, the farmer's spouse and children under 21 are not considered in determining whether the $20,000 cash wages or 10 employees test is met. Farm employers who meet either of the above tests are required to pay tax based on the amount of wages paid. If a farmer is subject to the Illinois Employment Act, the farmer must notify the Illinois Department of Labor within a specified time after operations begin, and a quarterly return and tax payment, called a contribution, must be filed. How about Social Security and Medicare? The question to ask is, when are farmer employees required to pay Social Security taxes on employee wages, and what procedures must be followed? Social Security taxes are applicable to almost all farmers, even if the farmer himself is the sole employee. Like other employers, a farmer has certain obligations to contribute to an employee's future Social Security benefits. Generally, employers are required to pay FICA taxes on the wages of an employee other than the employer's children under the age of 18 who has either received wages of at least $150 or is one of several farm workers who collectively were paid $2,500 or more during the year. Farmers and crew leaders also must withhold federal income tax from wages of farm workers if the wages are subject to Social Security and Medicare taxes. IRS Publication 51, the Agricultural Employer's Handbook, provides guidance on withholding income taxes from employees' wages. Moving beyond taxes associated with employees and self-employment tax, all farmers face the challenge of reporting farm income and expenses and paying income tax on net farm income. All farmers need to consult IRS Publication 225, the Farmer's Tax Guide, for regulations and guidance on preparing Schedule F, the profit or loss from farming. RuralTax.org's tax guide for owners and operators of small farms is very helpful, as is the Introduction to Agricultural Federal Tax Issues by Ruby Ward of Utah State University. Remember that establishing and running your farm as a business is essential if you are to be able to deduct legitimate farm expenses and establish net income. Hobby expenses and losses are not deductible. So how does the IRS assess whether or not your farm is a business or a hobby? It's a business if it's profitable in 3 of the last 5 years, period. If not, IRS examines whether or not the endeavor is carried out in a business-like manner. Is it run as part of an LLC or under a separate banking account? They assess the expertise and training of you as a farmer, whether or not you devote significant time at your farm and doing what. Are your assets expected to increase in value? Do you show evidence of experience and training? Is there an ongoing examination of the practices at your farm to try to improve profitability? Have you had some profits, if not in the last year or two? What other income do you have? And does it appear that your farm is run just for fun or indeed to make a profit? To document that your farming effort is a business, record your farm with FSA. Develop a viable business plan. Keep books separately for your business and versus your other income. Show some profit. And keep written records of time spent working or attending training, ways you've tried to increase your income, and records of the reasons for your losses. If you are a business, you will probably need a federal EIN, and that certainly will be true if you structure your business as an LLC or an S-Corp. You'll need to register with the Illinois Department of Revenue at the Illinois Business Gateway. And if you hire employees, you will need to register with the Illinois Department of Employment Security. And be sure to get IRS Publication 225, the Farmer's Tax Guide. The Farmer's Tax Guide covers records, accounting methods, expenses, deductions, depreciation, self-employment taxes, employment taxes, excise taxes, and estimated taxes. RuralTax.org offers several sample tax returns for different kinds of small farm businesses and explanations about how those returns are done. One that you might find very relevant is the sample tax return for IMA Hopeful. State income taxes typically are based on federal tax returns, and we will not go any further with that. Remember that you will need to pay self-employment tax on your farm net income. Payment is not required if your farm profits are less than $400, but you are required to pay 12.4% on income up to $118,500 for 2015 for your FICA taxes, and 2.9% on all profits for Medicare. And Publication 225 provides instruction on payment methods and schedules. In your farm business, you will also need to become more familiar with IRS Form 1099. The 1099 is called an informational return, and the IRS uses that form to match income and expenses on different tax returns. The issuer of a 1099 sends one copy to an individual and the other to the IRS. You may need to issue them or you may receive them, and the income then needs to show up on your tax return. Form 1099s are required if, in terms of a 1099 miscellaneous form, for payments of $600 or more for rents and services, or payments of at least $10 in royalties. The 1099 interest form is required for payments of $600 or more of business interest. Some payments you make are not subject to Form 1099 reporting. For example, payments other than medical or healthcare payments made to a corporation of any kind need not be reported. Payments for merchandise, phone service, freight, storage, similar items do not require a 1099, nor do payments of rent to real estate agents. Wages and business travel allowances paid to employees do not require filing a 1099, nor do payments made to tax-exempt organizations. So if we look at some 1099 reporting examples, a $4,000 herbicide purchase does not require a 1099 because it was merchandise. The consultant fee, $1,200 to look carefully, a certified crop consultant, does require filing a 1099 because the payment was greater than $600 and Mr. Carefully was not a corporation. The soil testing payment shown in this slide would not require a 1099 because it was paid to a corporation. The plowing expense shown here would not require a 1099 because it did not exceed $600. And the grain hauling expense also would not require a 1099 because it was paid to an LLC or a corporation. The rent payment here, $5,000 cash rent to the sister of the owner or co-owner, does require filing a 1099 because it exceeded a certain value and was not paid to a corporation or LLC. The interest payment that's shown here does require a 1099 because it was greater than $600, and the repairs shown in the last line do require filing a 1099 because the amount exceeded $600 and it was not paid to a corporation. Remember too that you will need to pay sales tax on your farm sales of fruits and vegetables. The tax rate for food is based on whether or not it is intended for consumption on or off the premises. Food for human consumption off the premises and not for immediate consumption has a 1% tax rate. The general 6.25% sales tax rate applies to all other food. So is it food or not? If a pumpkin patch sells pie pumpkins and gourds, the pie pumpkin, if not intended for consumption on the premises, qualifies for the 1% tax rate. The gourd, if not edible, should be taxed at the 6.25% tax rate. Establishments that sell food primarily, and by that we mean more than 50% of their sales, in individualized servings that are deemed to sell food for immediate consumption will pay a 6.25% tax rate. And the 6.25% sales tax rate applies to all sales of hot foods and all sales of alcohol. And do remember that units of local government may levy additional sales taxes above the 6.25% rate, and you can look up those rates for different localities at the sites shown in this slide. So you know there are times you will charge and then pay sales tax for the produce you sell from your farm. There are times when you are not required to pay sales tax on purchases you make for your farm. When a direct farm business purchases items from another business that are related to farm production, the purchase is exempt from the sales or use tax in Illinois. These kinds of purchases may include farm chemicals, certain machinery and equipment, or replacement parts. When a direct farm business purchases farm machinery or equipment primarily for the purpose of farm production that's incident to the purchase of that service or equipment, the goods are exempt from the 6.25% sales or use tax that we've been talking about. The same is true for excise taxes. IRS publications 510 and 225 explain fuel excise taxes as well as which uses of fuel qualify for tax credits and refunds. Fuel used on a farm for farming purposes and fuel used for off-highway business purposes are exempt from excise taxes. Farmers may claim the tax as a credit at the end of the year or obtain quarterly refunds of the tax depending on how the fuel was used. To substantiate claims, the IRS requires businesses to keep certain records, including the name and address of the person who sold the fuel. And at the state level, the motor fuel tax law in Illinois and its accompanying regulations state that any person who uses motor fuel for purposes other than operating a motor vehicle on a public highway can seek a refund of the state excise tax on that fuel. Refunds are available to farmers for gasoline and for undyed diesel fuel. And there is a form that's used to make a claim for an Illinois motor fuel tax refund. And again, purchasers must retain proof of the taxes and of the purchases. And finally, property taxes. We'll only barely wade into this topic, but do be aware that the term farm does not include property primarily used for residential purposes, even though some farm products may be grown on, or farm animals may be bred or fed on property in a way that's somewhat incidental to its primary residential use. The assessment value for farm dwellings and parcels of property on which farm dwellings are immediately situated is 33 1/3% of fair market value rather than the agricultural economic value of that property. Improvements, which include buildings such as on-farm retail stores or processing facilities for value-added products, are assessed as part of the farm when such buildings contribute in whole or in part to the operation of the farm. Their assessment value is 33 1/3% of the value of the building's contribution to the farm's productivity, which is usually similar to the building's fair market value. For property taxes, it's often very much necessary to contact county boards and assessors, and there are ways that you can appeal or change the status of property and how it is taxed. Finally, a reminder from the early slide. In the long run, when it comes to tax issues, do not be too frugal to pay for the services of a qualified attorney and to pay for the services of a qualified tax accountant familiar with farm taxes. Thank you, and if you need to get in touch with us, meaning the Beginning Farmer program as a whole, please contact me or Mary Hosier with the information in this slide. Thank you.